and welcome to today's episode of the Daily Dose. Today is Monday, November 14th. I hope everyone who's watching or listening to this episode had a good weekend. I just want to say, if you like this type of content, please subscribe on YouTube and follow wherever you listen to podcasts. If you didn't listen to this weekend's episode of the Weekly Wrap, be sure to do that. It was a little bit different format than what I usually do. I just kind of talk through some things that I really just wanted to talk about that I didn't get a chance to do really during the week when I'm doing these Daily Dose episodes, because these episodes are really more tailored towards just kind of recapping the day and giving some quick thoughts. And this weekend, I went a little deeper and do a couple topics that I've kind of been thinking about and that were relevant to last week. So be sure to go listen to that. I thought it was a good one. And let me know if you like that format better than the one that I usually do. I'm thinking that I'll probably just switch between the two for now. And then whichever one works better, I'll probably stick with. But as far as today goes, stocks were down today. S&P 500 was down 0.89. The NASDAQ was down 1.12. And the Dow Jones was down 0.63. So U.S. stocks seesaw on Monday, but ended the day lower as Wall Street waited for another round of earnings and key data from the retail sector. I'm going to skip over some of this earnings stuff here, but I'll read through this first. So stocks had ended last week with their biggest gains in months, with lighter inflation data sparking hopes among investors that a monetary policy shift is near. The S&P 500 rose nearly 6%, while the NASDAQ added around 8% for the week. So massive gains there. Treasury yields advanced Monday, and the dollar held firm following weekend comments from Federal Reserve Governor Christopher Waller, who said the central bank still has, quote, a ways to go with interest rate hikes. This isn't ending in the next meeting or two, he said. The comments echoed hawkish remarks this month from Fed Chairman Jerome Powell and reinforcement from other colleagues who also reaffirmed the rate increases were far from over. So I think this is important for a number of reasons. I think that last week people were getting a little bit ahead of themselves as far as a policy pivot coming from the Fed. They've mentioned many times that they're not just looking to one data point as far as creating their policy goes, and that they're going to be looking for a trend, and that there's still ways to go. Even if there was a trend that inflation was coming down, the reality is that it's still 7.7%, and it's going to take a lot of work to get back down to 2%. So I think it's a little bit dangerous to get involved with some of the FOMO that's going on. Again, this could be another bear market rally. We'll take a look at the chart in a second and talk about it. But even though that's a great data point, it is just one data point, and if the Fed's going to continue to raise rates and inflation remains high and we have all these international geopolitical factors going on as well, it wouldn't be unreasonable for the market to come back down to its lows or even break through the lows. So just a reminder to be prudent, always manage your risk, especially in these types of markets, and don't get ahead of yourself, don't get caught up in the FOMO. It was a great week last week, but just remember to stay centered and stay emotionless when it comes to investing. So I'm going to skip through a couple of these earnings because I'd just rather get to the economic data. This doesn't necessarily have to do with what I'm talking about right now. So let's see. This is actually relevant. So data from FactSet Research shows as of Friday, 91% of companies in the S&P 500 have reported third quarter earnings, with 69% reporting actual earnings per share above the mean estimate. That's below the 5-year average of 77% that beat. So we're still seeing earnings sluggish. Another reason why you don't want to get ahead of yourself as far as these market rallies go. It could take a couple quarters for these earnings to come back, and we could see the market kind of go back down and maybe make new lows or go back to the lows as these earnings recover, even if inflation does start to come down and interest rates rise, but at a slower pace. And even if they end up pausing or even reversing the policy, it'll take a couple quarters for these earnings to come back and for the valuations on the market to then be justified. So don't get ahead of yourself. Again, that's why I love dollar cost averaging, because then you're going to be constantly investing in these companies no matter what the market's giving you. And when it goes down, you'll get more shares. And when it goes up, you'll be able to stay investing while the value of your portfolio goes up. So I like that they included that little data point there. Also on Wall Street's plate is another round of economic data, including the monthly retail sales report out Wednesday. Economists surveyed by Bloomberg forecast a headline 1% increase for October after spending was unexpectedly flat in September as consumers pulled back on big-ticket items amid high inflation and climbing interest rates. Wall Street strategists have also begun releasing their outlooks for 2023, with Morgan Stanley chief U.S. equity strategist Mike Wilson seeing more rough patches ahead. And here's a quote from him. While his year-end 2023 base case price target of 3,900 is roughly in line with where the market is currently trading, it won't be a smooth ride, strategists led by Wilson wrote in the bank's 2023 equities outlook. The road not taken. After what's left of this current tactical rally, Wilson sees the S&P 500 discounting the 23 earnings, 23 as in 2023 earnings, risk sometime in. Wow, they messed that up there. So it says that Wilson sees the S&P discounting the 2023 earnings risk sometime in, and then it just says Q123 via a 3,000 to 3,300 price trough. So maybe that just means that sometime in the first 3 quarters next year he sees that happening, but he does see the market going down to even a 3,000 to 3,300 level. That's interesting. I know we have the 3250 on our charts, but yeah, I could definitely go lower than that. Elsewhere, President Joe Biden met with Chinese leaders Xi Jinping on Monday as the U.S. attempts a stronger alliance with nations that can help discourage China from taking military action against Taiwan. Meanwhile, the world of cryptocurrencies continue to see a fast-moving sequence of events. The collapse of FTX International has threatened losses for both big and small investors, with FTX filing for bankruptcy on Friday in a stunning fall for a crypto empire. The fallout continued over the weekend. FTX probed a potential hack and asked customers to stay off the website, while crypto exchange Crypto.com sent $405 million to the wrong recipient. Bitcoin fell 0.7% to 16,246 by the end of Monday's U.S. trading amid FTX's deepening woes. That was a really interesting story that came out of Crypto.com, actually. The recipient of the $405 million sent it back to them, which is just absolutely incredible. I don't know if I'd be sending back $405 million. Maybe I'd send back $305 million. But I just thought that was a crazy story. How can you let that happen? I don't know. But yeah, a lot of stuff going on in the crypto market as well. So let's take a look at the charts. Let's take a look at the S&P 500 first. So we kind of came to the top of this level. And if you look at my dashed line right here, and if you can't see it on the podcast, it's right at 4,010. You'll see that there was a little bit of resistance there, not really, but that's where it ended up stopping today, and it came back down. It's right inside the top of our zone now, which goes from 3,980 to about 3,893 rather. And so we're kind of just in that zone right now. Again, I think that this rally was really fueled, especially from here on out, was fueled by that CPI data point that was only 0.2% lower than expected, and it was just one data point. So again, maybe we're getting a little ahead of ourselves here. I could still see the market bowling into this trend line or this moving average, probably the moving average. I don't really see it breaking through the moving average. If it did that, that would be significant and surprising. Not impossible, but surprising. And then coming back down, again, we could come back down to our previous lows, or we could break through. I have my eyes set for this somewhere in this zone near the 3250 as far as a next leg down would go. That doesn't have to happen, but that's what I'd be looking at. And that'd be a good price to be an investor as well, if you're looking to buy and hold. But let's take a look at Bitcoin, because this whole crypto debacle has been just really interesting, but it's kind of pushed us through the bottom of the zone. We came back up and tested it and came back down, so that really confirmed this move for me. I'm still looking anywhere between the 12,300 and the 10,000 as an initial level to get in. It could break through the 10,000. That would be big, but I think the 10,000 is a good psychological number for investors. So this would be the first zone that I'd be looking to put in a lump sum. And then if it does get to this level, I'll start talking about the next one down, and we'll keep doing that as it falls. But yeah, I'm looking to this as a long-term hold. That's low enough for me to get in and not try and time the market any more than that, and hold for a long time. If you can get in at that price and hold for 10, 15, 20 plus years, I mean, my confidence in that is really high. So I did talk about a little bit about self-custody in the weekend episode, and I had someone comment that if you can't take self-custody, that brokerages like N1 Finance might be safer than these big crypto exchanges, which that's probably true. I haven't actually done a lot of research in things like M1 Finance because I pretty much just wanted to take self-custody. But I'm sure that is true. There's a lot of risk in these exchanges, and anything where you have control of your keys or can somewhat take custody of your coins is safer than that. And they also mentioned to recommend more podcasts or books. So I'll be sure to do that in the future. And honestly, if I can get some people to start asking just like questions in the comments, then I'll start doing maybe some Q&A episodes on the weekends too. I think that would be pretty cool. I want to get more engaged with the people that are actually viewing these episodes. So if you do have any questions, you can send it to my email, which should be in the show notes for YouTube and the podcast. But if it's not there, it's just thefinancialwrap@gmail.com. So if you have questions, you can definitely email me there. And if I can get a couple, I'll do a Q&A episode on a weekend sometime. And I'll be sure to make some more recommendations in the future. I definitely have a bunch of really great podcasts that I listen to myself. And I do know of some great books as well that really help with investing and just the understanding of money in the system in general. So I'll be sure to do that in the future. And I do appreciate that comment coming through. I like to get engagement from the audience. I think that's cool. So definitely do that. I'm going to leave this episode here for now, though. This is already a little bit long for a Daily Dose episode, so I hope everyone had a great day. I hope that you enjoyed this episode. If you did, subscribe on YouTube and follow wherever you listen to podcasts. And until next time, we'll see you tomorrow.